I guess, Julian, if you would like to start the recording, you're welcome to do that now. And I'll get started with the hellos and the land acknowledgement. Good morning, everyone. My name is Linda Griffin. I'm the Education Programs Coordinator with Business Link. Thank you for joining the webinar today. At Business Link, we always begin all of our meetings with a land acknowledgement. And we are honored to provide services to all entrepreneurs and specialty services to our immigrant and Indigenous entrepreneurs. We want to acknowledge that in the province of Alberta, we are situated on the traditional territories of Treaties 4, 6, 7, 8, and 10, ancestral homeland of diverse First Nations group, Métis and Indigenous people whose ancestors have walked this land since time immemorial, and whose histories, languages, and cultures continue to influence our vibrant community. We pay respects to the Indigenous people of this land, past, present, and future, while recognizing their cultural heritage, beliefs, and relationship to the land on which we reside. Thank you for joining us today. Vanessa Brown is going to be presenting why healthy balance sheets matter. If you'd like to ask a question during the webinar, click on the Q&A in the bottom of the meeting controls and type your message into the question box. We're happy to answer lots of questions, so please, if you've got questions, ask them. That's what we're here for today. And welcome, Vanessa. Feel free to take it away. We can see your screen and we're ready to get started.
Good morning. My name is Vanessa Brown and I am a CPA, and it's a pleasure to be with you. This presentation will help you to understand the concept of a healthy balance sheet and to learn how to create one. We have about an hour together and you will receive a copy of the presentation from Linda, and there'll be also a few other links as well. This is a little bit about me. I've been working in the accounting profession since 1995. I obtained my certified management accountant designation in 2003, which focuses on strategic leadership. And I obtained the chartered accountant designation in 2007, which focuses on tax, audit, and technical accounting disclosures. I completed the in-depth tax course in 2013, and I've owned and operated an accounting practice since 2009. I have two businesses. One is a professional practice that does year-ends, corporate year-ends and tax, and the other one is more to help business owners on the inside, and it's called the Small Enterprise CFO, but it's for fractional controllership and CFO services to the small enterprise. In the chat box, if you don't mind entering a few bits of detail about yourself, that would be helpful. And then I can tailor some of the comments to you specifically or your industry if I know a little bit more about it. So if you can put your role in the business, whether you're the employee, the owner, an employment role, what function you might provide to the business, the industry of your business, the stage or the size of your business. So is it the startup, the third year, or is it 100 employees? Is it 10 employees? That type of thing. You can also tell me if you have any debt or lease obligations. These are things that would be disclosed on the balance sheet that might be, it's helpful information for me when I'm looking at the balance sheet. And the fifth thing, what you hope to gain from the session. And I will read some of those chats as I present and can tailor accordingly. So some common questions that business owners will have, or common questions that I'd say almost all small business owners have. What does having a healthy balance sheet mean? What does that look like? How do others, if I've got bank or leasing obligations, how do others look at my balance sheet? And what kinds of measures might we have about the balance sheet health? What does an investor look at? I'm looking at bringing in a shareholder. What would they be looking at? And what does the bank look like? And then a bigger question, how can I cure an unhealthy balance sheet if I have one? So a healthy balance sheet shows that the company has adequate solvency and liquidity, meaning that it can pay its current debts and it has enough cash to pay operating costs and obligations. It will also show that there is appropriate borrowing, meaning that sometimes business owners are averse to borrowing money, and yet there is a benefit to being leveraged sometimes. It also shows that the company has adequate capital meaning share capital or retained earnings, to support ongoing operations. And then there may be some positive trends and forecasts, which comes from graphic charts. So the top three all come from a ratio analysis. And then the trends and forecasts, we would actually graph information from balance sheets over time. A balance sheet is a statement of assets and liabilities at a point in time. So the graphs and charts would show maybe the end of month for the last 12 months. It may show every week, the end of each week for the whole year, 52 weeks. And we can just take a look at those types of things. So who uses the balance sheet? That would be business owners and shareholders that are the main users of it. And if you are a business owner or shareholder, it is something that should be reviewed at least monthly. If your business has any investors or lenders, they will be using the balance sheet as well. Some banks, it depends on the loan. Some banks might require it monthly, maybe only quarterly, and maybe only just once a year. And then any potential partners. So anybody who might be looking at buying your business or buying into your business, maybe you have an employee that is a key employee that's really got an interest in owning part of the business, they're also a user or potential user of the balance sheet. And a healthy balance sheet will equal some confidence in the business. So we will be looking at several of these ratios that are indicators of business health or balance sheet health. The first one is this quick ratio. So this is a measure of solvency and liquidity. The quick ratio, to calculate that, we take current assets minus inventory. So we're taking inventory out because inventory is not something that's as liquid as cash or marketable securities. So we only take a look at and accounts receivable. So current assets would include accounts receivable, cash, and normally inventory, but inventory is not as liquid as all of these other assets. So we remove it from the equation and then we divide it by current liabilities. What this does is it gives us a ratio of our liquid assets, which we would use to pay off our debts, to our current liabilities. So a ratio less than 1 is a liquidity problem, because that means that we have quick assets less than the liabilities our quick liabilities. The liabilities we probably need to pay in the next 30 to 60 days exceeds that. So we want that ratio to always be 1 or more. And some business lenders would want that liquidity ratio to be significantly higher than 1. So you need to have a conversation with your lender, or take a look at the agreement. If you are in agreement negotiations, you'd want to take a look at what is required in the agreement for this quick ratio prior to signing the agreement. And if it is a ratio that seems a bit, the ratio requirement is a bit too rigorous for your business, you can have a conversation with the banker, and these are negotiable items at certain loan amounts and with certain banks. So in our example, we have 150,000 in current assets, which includes inventory. We remove the 40,000 of inventory, and that leaves us with 110,000 of quick assets versus the 100,000 of current liabilities. So it's a 1.1 quick ratio. Now we'll take a look at interest coverage. So this is a measure of how much of our expenses, how much of our cash flow is going towards the interest. So we divide the operating profit by the interest payments. So this indicates whether a business is earning enough profit to pay its interest expenses. So in our example, we have an operating profit of $9,167. We have $750 in interest payments, which is a 12.2 interest coverage ratio. This is significantly higher than the 2 or higher that would be preferred by lenders. And just some comments on this. If it's a highly capital intensive business and it's just the first couple of years of operating, we might be closer to that 2 than this 12 that we're showing here. But over time, as the loan on the equipment purchase is reduced, then the interest portion would also come down. And ideally, we would also be making more profit inside the business as we've obtained more contracts and gotten more efficient with the equipment usage. Again, you need to have this conversation or take a look at the loan agreement before you sign it to determine what they're requiring for this times interest earned calculation. Then we have a fixed payment coverage. So fixed payments includes any regular recurring payment. It can be the lease payments, it can be loan payments. In this example, we are dealing with the lease payments. So to calculate this, we would take our operating profit and add back the asset lease payments, because those lease payments would have been expensed in the expenses portion when we were calculating profit. So we take the operating profit, add back the asset lease payments, and then we divide that by the interest plus the principal on our mortgages or term loans, and then add back these lease payments. So this is to verify that we are making enough money in the business to adequately cover all of the fixed expenditures associated with the business, the contractual obligations that we have. So again, a ratio of 2 or better is preferred by lenders, but this will also depend on what industry you're in, what stage of business you're in, and what your bank requires. So you do need to have conversation with your lender to figure that out. In our example, we have $7,167 of operating profit. Then we add back our lease payments and we divide that by our loan balance of $2,750, and then we add the lease payments to that as well. And this gives us a 2.6 coverage ratio. So now, does the company have adequate capital? To do this, we would take a look at the debt to equity ratio. The debt to equity is our total liabilities. So this is accounts payable, any payroll taxes, sales tax payable, any income taxes payable, plus any current portion of loans. We put those all in the numerator and we divide that by the owner's equity. So this is a measure of how leveraged the business is. Businesses that have a larger capital, meaning that, well, they're more capital intensive. These are businesses that have a lot of property, buildings, land, equipment. They will have higher ratios than non-capital intensive. Service industries, consulting companies, things like that, they are not generally capital intensive, so their ratios will usually be lower. Again, lenders prefer lower numbers, 2 or lower. And let's think about this. The owner's equity includes the shares that were purchased, the initial share capital that was purchased, and plus the retained earnings, so the earnings that have been retained in the business over time. This represents what the owner has invested into the business. The owner's equity represents what the owner has invested, and then the liabilities is what has been invested by others. So, you know, what's owed to suppliers right now. They've sent goods to us and now we have to pay them back. But then also the bank, the current portion of the bank obligation. So in our example, we have 200,000 in loans. We have 100,000 in owner's investment, meaning the combined total of the share capital purchase plus retained earnings. And we end up with a 2.0 debt to equity ratio. So this slide defines the concept of working capital. Again, this is a measure of, does the company have adequate capital to continue operations? Working capital is a measure of the liquid assets that are available for the operation of the business. It's defined as the difference between current assets and current liabilities. The current assets include cash, inventory, accounts receivable. So unlike the quick ratio, we do include inventory in this calculation of working capital. And the current liabilities are the accounts payable. It can also include a line of credit if there is an outstanding balance on the line of credit, and it can also include the short-term lending, the short-term portion of any long-term loan. So any of the debt that's due within the next year. Again, we are using a 1-year time horizon. So it's any accounts receivable that were received within the next year. Most receivables would be, for most businesses, are 90 days or less. Accounts payable are 90 days or less. But again, we would also include any portion of the loan that is due within the next year. In this example, we've got current assets of 105,000. We've got current liabilities of 15,000. So we end up with a working capital of 90,000. We always want this working capital number to be positive, and preferably a healthy positive number. So now let's take a look at some trend analysis. In this case, we compare the relative change in values from period to period. So this is some examples. As I mentioned earlier, we might graph the balance sheet at the end of each week. So every Friday, the end of that day, we take all of the balance sheet information and we graph some of these ratios. So we graph the quick ratio, we graph the working capital ratio, the debt to equity ratio, and or we can just graph some of the balance sheet amounts and take a look at whether our accounts receivable are growing, whether our cash is growing, whether it's declining, whether our ratios are improving over time. So at the end of each week, end of each month, if we've got multi-year data, we might look year over year and see what that looks like. And the key things that we're looking for are what's increasing, what's decreasing, what's staying the same, what other trends can we see on that? And then this can also give some insight on how our product or strategy changes have changed our balance sheet. So in all of these, we would take a look at some kind of a growth rate, which is the ending balance minus the beginning balance divided by the beginning balance, gives us a percentage. So here's 2 different companies where we've graphed accounts receivable over time. We are graphing it monthly for a period of a year. And we see that the budget on firm D was to always have a receivable balance of about 80,000. So this must be a pretty steady business throughout the year, something that doesn't have big changes in revenue from month to month. So probably not a retail business, where retail would be mostly around Christmas. because I'll say this, as if revenues fluctuate a lot, we might see a lot of fluctuation in the accounts receivable balance as well. So this seems to be, because they're budgeted to be consistent, they are a consistent month-to-month revenue company. And then what we see with actual is that the actual receivables are growing. They were slightly higher than 80,000 at the beginning of the year, and now they're getting close to 100,000. Firm G, on the other hand, also had this steady 80,000 budget, and we see receivables going up and down around that 80,000. So we, start below 80, we go maybe to about 85 or 90, sit at 80, go up to closer to 95,000, and so on. So, the question is, what could be some of the reasons for the differences in these scenarios? And when we look at Firm D, there might be a concern that some of the receivables aren't being collected in a timely fashion, and they're just sitting, maybe some of them have been sitting there for the entire 6 months. And that creates some concerns about the liquidity of the customers we're selling to. Do they have the money to pay us? Have we sold to customers that maybe we didn't do a credit check on? Another possibility, we can't look at accounts receivable just in isolation. We need to understand the revenues as well. Another possibility is that maybe they budgeted for revenues to be, let's say, 800,000 a month, so that this receivable is just 10% of their sales each month. But their sales increased. So now they're sitting at, $1 million per month in sales. And if that's the case, if they've increased their sales, monthly sales, then as a percentage, the receivables are reasonable. They're still sitting around 10% of that. We need to dig in and find out a lot more information about the company and what's been going on. But at first glance, this can be a concern. It's like, what's happening? With the Firm G, again, this might be just what happens. Maybe they do a lot of their sales close to the end of the month on a couple months, and so their receivables go up just because they made most of those sales in the last 3 or 4 days, and they don't collect it until 10 days later. But we would need to, again, look at the revenues that they had. If their revenues are consistently, let's use that $800,000 a month in sales revenue, then it's just the timing in the month that's contributing to these fluctuations. If, on the other hand, sales have been declining and they're still sitting at this, maybe there is a concern. We don't know entirely on its own. At first glance, though, if these companies have similar revenue structures, so they're making $800,000 per month, if we've looked at their comparative income statements as well, the Firm D has a greater concern just because it's growing, whereas Firm G, it's hovering around that, and it's, but it's still pretty close to that on average. So what does the bank look for on your balance sheet? They are looking to make sure that they can collect their debt. They are looking to see that they've also assisted you in your business in whatever objectives it has. But the key thing is that they're going to receive their payments on a regular basis, and they will receive their loan back over time. So they, generally speaking, they'll just lend you the money according to certain terms and conditions that they've listed in the loan. And as long as you make your payments on time, there won't be too many questions asked. They're going to be pretty hands-off. They don't want to get into your business. They just want to make sure that their business is covered off, that they lend, they make their interest return for the bank and for their investors, because the money that they're lending to you has come from other people who've invested in them. And so as long as they're making their money, then they don't generally ask a lot of questions. Their loan agreement will tell you what you need to report to them. And that's, for a lot of lenders, that is just an annual financial statement, and they might ask for the tax return to show that the tax returns have been filed and that your tax obligations are paid for, because the bank sits as second creditor to the government for debts. So they always want to make sure that your taxes are paid. And if your taxes are paid, then they are usually the first creditor that can access your assets if you don't make payment. Every lender has a portfolio of companies that they're working with. And from my experience, that sits usually somewhere around 100 to 150 clients. So they will only focus attention on their key clients. So again, as long as you make payments and file your reports when you need to, then they will just accept the reports, and you generally won't hear a lot of questions from them. A couple things too that the banks or credit unions, some other things I want to relay to you that may be required or may be surprises to you about the lending. They may specify when those reports have to come in. They might be charging some kind of a fee when they are doing the lending to you, or when you are renegotiating any loans with them, maybe a financing fee. Know that you have some ability to negotiate any of the terms that are in those agreements prior to signing the agreement. So always make sure that you've read through and understood the different ratios, the timing of reporting, what kinds of reports. An example, so oftentimes the lending agreement will default to audited financial statements, but for small businesses, there's generally not a need to have an audited report, and an audited set of financial statements is quite expensive. The audit fee would generally be somewhere around 15 to 20,000, which is a lot for a company. And so if it does say that, number one, it's probably an oversight because they've used a default contract. But number two, identify it and go and have a talk with the lender and make sure that a compilation report is what they've gone to. Or sometimes a review engagement might be appropriate, depending on the amount of lending. My finding with the banks is that $200,000 and less in lending is okay with a compilation engagement. Once it's above the 200,000, the bank may require reviewed financial statements, which includes a bunch of note disclosures and an additional amount of analysis that the year-end accounting firm must do. You can review what those covenants, what all of the covenants are. So sometimes the covenant is simply just make your monthly payments. Other times the covenant is more extensive, requiring certain ratios, requiring that you give them monthly reports for accounts receivable and inventory balances. For the accounts receivable, a detailed listing all your customers that owe you money. They might also require an accounts payable list, and that is also listing your suppliers and what you owe them. Sometimes that may feel like it's information that you maybe don't want to share, but you have to make sure that you understand these covenants upfront, and then you can renegotiate them if you don't agree with some of them. So now, what does an investor look like? My most common scenario is that the key employee that's deciding to take over and run the business. Somebody who might be a little younger than the current owner, and their livelihood depends on the business, and they know it well, and they want to take over. Others that may be investing is, maybe somebody who has capital and sees the promise of your business and wants to advance that. And so they become a silent partner that just invests in usually preferred shares. Maybe they give you a loan as second guarantor to the bank, and you might might pay them a little more interest on that. Or it may just be a friend that wants to join in the business with you, and you do work well together. All of these are possible scenarios. So the investor wants to become your partner. They are focused on participating in the future success of the business. So they'll want a return. And so if they've invested in shares, in common shares, they will want to receive some dividends as a result of their investment. The investor might be somebody who adds expertise or adds some business contacts to your network and therefore helps your business grow. If sometimes these investors may come in and be, the comment here on the slide is that they might be intrusive. That will depend. So if it's somebody who's just a angel investor that just wants to add some capital to your business, they see the promise and they just want a return on their money, they won't. Those types are generally not intrusive. The ones that are more intrusive are the ones that, maybe it's your buddy that has a lot of expertise in something that you are doing in your business and you want to bring them in as a partner. They may want to change the strategic direction of your business. And that's okay as long as the two of you are in alignment with that and you can agree on those terms. So be aware of the contractual obligations that you're signing. Have a lawyer be involved in documenting these things. And more than anything, the lawyer is an advisor at this stage. They can give you a lot of insight into the types of contract terms you need to consider. The lawyer has a breadth of experience with lots of businesses, and it's their consult that you're looking for at that stage of writing the contract. So always involve somebody upfront. They can avoid all kinds of hassles at the end. And they may just identify for you that the person that's wanting to invest has just got other ulterior motives that you're not interested in pursuing and can help you avoid a bad contract. The investor can also trigger some painful provisions if performance targets are not hit. So a common clause in an investment agreement or a unanimous shareholders agreement, when you're bringing in another shareholder, a key item is something called the shotgun clause. This is a clause that can be triggered if one of the investors, one of the shareholders, feels that the other shareholder manager is not upholding their part in this, and they will offer to buy your shares in a very short period of time. So if they have lots of capital, they can trigger that and end up acquiring all of your shares, unless you are able to counter it with your own capital to buy those shares. Very common clause in the unanimous shareholders agreements. It's a way for shareholders that are not in alignment anymore on the business. It's a way for them to resolve that disagreement and still carry on the business. So be sure when you're bringing in a shareholder that you understand all of these different clauses and that you've contemplated what happens if we don't agree on strategic direction, say 10 years from now. What provisions are in the agreement for us to resolve that conflict and maintain the business? Because as the business owners, you're generally looking for the interest of the business to be of primary and utmost importance. And in that, it's making sure that the employees of the business are cared for as well. So a lot more than just the owner interests. Now, what do we do to cure an unhealthy balance sheet? So the first thing we want to do is identify the symptoms. So let's take a look at all of those ratios, take a look at the trend analysis, see what kinds of trends we see, and then, what symptoms are we seeing? We having a hard time paying our vendors, don't always have enough cash to do so, and then, okay, well, what's leading to that? Is it we're not collecting our receivables fast enough? Do we need somebody to get on the phone to our customers and get them to pay us? Do we need to make our customers pay deposits so that we have the cash flow up front to pay our vendors on time? let's take a look and see what the symptoms are. Let's take a look at what the underlying problems are that are making those symptoms appear, and then identify any contributing causes. Are we charging enough on our prices? Have we done a market comparison on our prices? Maybe we need to charge more, and then that maybe our supplier costs have gone up. We have to take a look at all of these different things. Then once you've identified the symptoms, the problems that are contributing or that making those symptoms occur, any other contributing causes, then you develop an action plan of what to do. So we can't just change prices overnight because that could hurt our relationship with our customers. So you now create this action plan. We do need to increase prices. So in 30 days from now, we'll send out an announcement to all our customers, tell them that our prices are changing on January 1st, and or maybe February 1st, because they need some time to adjust on their end. And then we will do these price adjustments. That's just one of many examples that might be. And when we make that action plan, it's often multifaceted. So it might be increasing prices. It might be changing our billing timing or receiving deposits in advance. And it might be all of those things, and that we would plan to phase them in, or we plan to communicate that this is happening, 2 or 3 months down the line, so everybody has time to prepare. And then we need to forecast what those results look like. So in the example of changing prices and how we do our billing and the communication that goes out, we would create a forecast that would increase our revenue, because it's assuming that all our customers stay with us. We might forecast that 5 or 10% of our customers fall out of the mix, just in case, because maybe our customers don't like those payment terms, and there's other competitors out there that would allow them to continue with the same structure they currently have. We need to contemplate all of these measures, all of these things that we implement, and what might be some of the actions of others that taken. And then we revise the plan. So if we've made a forecast that all of our customers are going to stay when we increase prices, and then 1 month after we've made the announcement that our prices will increase 3 months from now, we might have found out that some of our customers have said, look, we're not going to use you as a supplier anymore. So then we would revise our forecast with that new information and see if this still benefits the business, because at that point we can still make some changes to that plan. But that forecasting can involve a lot of different variables. We generally do some kind of a sensitivity analysis, or what I also call a scenario analysis. So if 100% of the customers stay, this is what happens. If 90% of our customers stay, this is what happens. Revenues are this much, expenses are this much, and our net income. And maybe we gain new customers because we go out and do some marketing on our new plans, and we have a scenario that has 110% of our customers. So some things that you want to make sure that are also in I'm going to just have a list here of some things that might be some symptoms or underlying problems that I haven't yet shared. Sometimes we find that there are excessive shareholder draws. So maybe the cash isn't there to pay our vendors because the shareholder has removed more money out of the company than the company can actually afford. So it's either through a shareholder draw or through some dividends that they've taken. In which case we need to, first we need to see what the agreements say with the bank, because the bank might have a restriction on how much money the shareholder can remove from the company relative to any financing they've provided. So and then if they're exceeding that draw, then we definitely need to call back some of the money. Sometimes the cash flow might be affected because we've financed some capital assets, and we have to evaluate whether those capital assets are producing the way we hoped. And maybe we need to sell an asset and pay back the debt if it's not producing the way we thought. We might take a look at some of the timing. So again, if we have a cash shortfall, and our pricing is right, our customers are paying us, what we might need to do is take a look at extending some of our payment terms to our suppliers. Maybe we are paying our suppliers 2 months in advance of when the sale actually happens from our business. So we need to take a look at all of those different timing things and really assess and analyze the business. One other thing, if you are an inventory type business, then maybe we're holding too much inventory. Maybe we need to buy less inventory. The key thing to take away on this is that you really need to take a look at what has been happening. Have a forecast, have a budget. A budget I look at more from an expenditure point of view, but have a forecast of what business sales would also be. And continually update that forecast as real information happens. As accountants, we call it a budget generally for that 1 year budget that we've done. And then the forecast is something that is real time changed all the time. So we reforecast at the end of each month. And if we've fallen short of the budget, we will reforecast for the year and revise what that might look like. And we also try and do corrections real time to try and get that forecast to be closer to budget. So that's all I have to say on all of this. And there's a few things that Linda will be sending out to you. There is a document that has some terminology that we've discussed today. There is an implementation checklist for you to be able to review your balance sheet on a regular basis and do some ratio analysis on your own, do some trend analysis. There's some information from the Business Development Bank of Canada. The BDC is a really good resource for all small business owners, and they have a lot more information on lending, on doing forecasting, doing business planning. They've got all kinds of really great resources, and I refer many of my clients to that, especially in their startup phase. And there's another document that the BDC has called the balance sheet, looking at all the definitions of all of the different items that could be on a balance sheet. So if there's any questions, I did see in the chat that a forecast is very important to have a good person to do it. And I will say this, if you are a business owner, you need to be part of that process. So you might have somebody develop the forecast. The key thing is this on the forecast: documenting all of the assumptions that went into it. So it's one thing to put, I'm going to have sales of 800,000 a month. It's another thing to explain how it is that you get there. Is it 10 customers at 80,000 per month? Or is it, 800 customers at $1,000 per month? How does this work? And then how does that relate to capacity needs inside the firm? And so the business owner always has to be an active person in knowing whether those assumptions can be met.
Thanks, Vanessa. Looks like we have a couple minutes for questions if people do have them. Now is the time to do it. I know that we have Michelle Hoover here who says she's startup and not sure where to start. Well, the financial statements, now that you've seen why a healthy balance sheet matters, we do have recordings of our previous sessions, which are intro to financial statements, that sort of thing. If you do want to review those as well, you can head to the Business Link website and check out the recordings we have of all the past CPA series that we've been conducting, along with this one. This one will go up shortly. I'm sorry, everyone, uh, I'm a little under the weather, so if I sound a little creaky, that's why. Yep, Mo Kelly says business owner has to be smart. Absolutely. I don't know. Some of us start out just not knowing what we don't know. I didn't know a lot starting out. The way to get smart is to do stuff like this. Uh, get involved with understanding and get involved with your accountant. A lot of people just sort of offload everything to the accountant and say at the end of the year, oh, just, make sure I don't have a lot of taxes to pay. And that is not a good use of your accounting professional. Or other people will say, I'm new, I don't have the ability to afford an accountant. It should be something you're striving for very early in your business. Um, Yes. So, Sawson, as a business owner, are there any trainings we should do to learn more about this? Absolutely. Go back to the recordings that we have on the Business Link website and take some of the, watch some of the videos. One of the things, you're very clear about is you're a science person, not an accountant. Yes, this is a lot to learn. So, one of the things I always tell people, because I've been a business owner too for about 30 years, is that it's not that you're learning how to be an accountant when you're taking this kind of information down and understanding this sort of thing. What you're doing when you're starting a business is you're approaching it the same way you would as though you were, for example, going to school to be an engineer, or going to school to be a lawyer, or going to school to be a doctor. There's all kinds of basics you need to learn in order to be a good doctor, all kinds of basics you need to learn to be a good engineer. There are basics you need to learn to be a good entrepreneur. It's very true that anyone, anywhere can start a business anytime. But to build a successful business is about doing some of the learning involved. So you need to understand that your business runs on processes, marketing processes, HR processes, operational processes, administrative processes, sales and marketing processes, and financial processes. And your role as the business owner is not to be the accountant, not to be the marketer, not to be the HR person, but your role is to be knowledgeable enough in the language of HR, knowledgeable enough in the language of marketing, knowledgeable enough in the language of finance that you can properly speak to and address the advisors and the professionals who are helping you. So, what that means is you know enough about all of this stuff. You understand what balance sheets are, what financial statements are, what cash flow is, the importance to your business, and how to read the basics and understand the basics so that you can move your business forward with the help of those people. So, it's definitely not something you need to learn. I mean, Vanessa, you go to school, you're updating yourself every month, annually, to keep up with what you keep up with as a professional. So a business owner is not going to do that. But a business owner needs to be able to speak to someone like Vanessa comprehensively and understand what's going on in the business, and it all resides in the financial statements. It's all there. So that's the key when you're doing this kind of stuff. Anything to add to that?
Yeah, no, that's it. I just put on the screen this one worksheet that it would have maybe been helpful for me to have put into the chat for everybody to look at while I was doing the ratio analysis. But um, this balance sheet for a small business owner, and I'll say a micro business owner, is fairly typical, and it's just at no point in time does a business owner need to know everything about accounting. They need to know what they need to know, which is, okay, do I have enough cash and accounts receivable to pay off my current liabilities right now? And that's what all of those ratios we're talking about. The other thing is to rely on the people who are helping you in that accounting and finance role, and to listen to what they are saying. The key numbers usually for a business owner is how many widgets do I need to sell, or how many contracts do I need to close? How much money do I need to be bringing in on a monthly basis to cover these particular expenses at this level? I want to have 5 people working for me. What do I need to make in sales every month? Do I need somebody with marketing expertise to come in and help me achieve those sales targets, or can I do that myself? And there's usually just a few key targets that the business owner needs to be aware of, and either calculate on their own from the information, the financial information, or have in-house somebody who is strong at that to help them, or somebody like my fractional CFO that comes in to help on a monthly or quarterly basis, take a look at the financial results, and then give feedback and help interpret the information that's there.
Thanks, Vanessa, so much for going through this today and just sort of laying the landscape for a lot of our clients as well. I know for some of our clients, if you're in startup, this may seem a little bit overwhelming, but I can assure you that every year and every month, as you work with the stuff more and more with your advisors and with people around you, the language becomes a little easier, and some of these concepts just start to become second nature as well. So it could take a while before that happens, but it does happen. I started out knowing nothing when I started my first business in the early 90s as a very young entrepreneur, and was fortunate enough to have an accountant who was patient with me, explained things in the office over and over again, and really worked with me to help me out. So I leverage that person as much as you can. On that note, it looks like we're finished up with this session for the day. We can certainly make sure the recording is posted. When I get better and I'm back full time at work in the next few days, I'll make sure I send out a follow-up email to everyone with a survey as well for how we did today. Thanks, Vanessa. Thank you, everyone, for attending. Julian, please feel free to stop the recording at this point. And